Yeah, I think the key is really for us in this fund, it's the short hold, right? That way you don't have to worry about interest rates going up or adjustments going down. If we're in and we're out, we're trading forward, and we're in and we're out, we're trading forward. We just focus on making the money going in.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Breneman, and this is the Breneman Blueprint.
All right, welcome back to another episode of the Breneman Blueprint. Excited for today's episode. I have Patrick Grimes on with Invest on Main Street. Patrick's been someone I've been following for a while. He's got a really great email list, I guess you'd call it, where I get these comprehensive emails where he's doing a lot of interesting things in the real estate space and also some other investments too. So happy to have him on, and he's got an exciting story. So welcome.
Glad to be here, Drew.
Perfect. Well, yeah. So I think why don't you just tell us about yourself? How'd you get going in real estate, and just kind of bring us to current day?
Sure. Well, I was educated as a high-tech professional. I have a mechanical engineering undergraduate and an MBA and a master's in engineering. Learned early on from actually the founder of one of the high-tech firms I worked for that he actually earned his money by taking everything he learned in high-tech and then dumping it into real estate.
Nice.
His only regret was not investing in more real estate sooner.
Yeah, I've heard that. Yeah, or the other regret people have is when they sell and don't buy more.
They still,
so
yeah. Well, I think for most everybody that advice rings true, but I got that advice in 2006. So my first investment, I think you started investing in 2005, right, Drew? So
right.
Yeah, you're a little bit familiar. So I invested in very, what I thought was like high, trying to double, triple my money every year or two. So I was very aggressive, young, snot-nosed engineer. I did pre-development, lost everything in 2009 and 10. Everything flipped upside down. Everybody went bankrupt. I didn't go bankrupt, but I pushed through and had to pay quite a bit to get out and took a big hit.
And what were those deals? Those deals like that was pre-development, so you're tying up land and getting it ready for someone to build on.
Yeah, my intention was to eventually build on it. Yeah.
Yeah. Right. Yeah. Perfect timing with that. So a lot of lessons on risk early on. Then I'm sure.
Yeah, it was just a couple of years ago that I saw that they finally picked that development back up again. So it's been a long time. Yeah.
Yeah.
But I like that still does ring true for that advice. And I carry that with me. And as I got more successful in my tech career, I started wanting to go, do it again. And what was I going to do with the cash that I had coming in the door? And I thought, well, I'll just go do the DIY real estate thing. And I, listened to those TV shows and maybe I'll flip homes. I was like, no, maybe I'll just buy them and hold them. And then I'll buy and find discounted properties. I started learning about recession resilient markets and buying for cash flow, not putting up not getting too much debt so that I could, the property would pay for itself. And if there was another recession, I could ride it out. So I started looking at how to be the tortoise and not the hare. And I found single family in Houston. It's very stable and decided to go that direction. And I did. It was working, just buying distressed, renovating, and then refining out and holding. But I was moonlighting it with my high-tech career. My high-tech career was crazy.
Also, you were living in SoCal then, or where were you? Because I don't think you were in Houston. You understand about your story?
No, I was actually up in the Bay Area. Yeah, in San Francisco area, Bay Area, right?
So you're doing that, 2,000 miles away or whatever it is, so that's That's adds a whole series of challenges too. How you can, I've moonlighted, but it was all local at least, or relatively local, where I could just drive to the property. Where this is hard to go on your lunch break to the property if it's in Houston. So
Right. Yeah. And I tell you what, that was the American dream though. It was, be really successful at some great revered career and then go become a property owner. And so but there was something wrong with it, right? Something wrong with it. In fact, I've got articles on Forbes where I outline the asset protection issues associated with that. And, Patrick Grimes' Forbes asset protection, for example, or the high risks associated with direct property ownership. And also, and the fact that it was impacting my ability to do what brought in the income that allowed me to invest in the first place. And it devastated my time, my free time with my family, friends, and hobbies. So when I met my wife, was soon to be wife, that's when I decided to stop doing single family. And we reapproached it after a couple of years and decided to partner up and do larger assets. And that's when I learned about passive investing into larger assets that are in recession resilient markets and larger multifamily apartment buildings that are non-recourse debt, that are very low risk with on-site property management you have to chase down. And then that allowed me to invest in a way where it didn't subtract anything from my family, friends, and hobbies. And I was able to become successful and in real property ownership and get the tax advantages and everything. And so that led to then myself becoming an operator and sponsor later on down the road. But a lot of my investors just are off enjoying their lives with real property ownership and not taking much of the risk at all and taking a lot of the upside, just investing passively.
right, yeah, it makes a lot of sense. How did you get going into your first deal where you partner with somebody, or maybe just you were had invested passively? But how did you make the transition from buying those single family either flips or rentals in Houston to then getting into these other deals? And
Yeah, well, I tend to be a little bit of an analysis paralysis kind of individual. I'm an analyst by nature. I have a master's in engineering with emphasis in systems engineering, and I did automation and robotics. So I attacked it like I was building a new process. I downloaded every course I could find and went to conferences and workshops and learned everything I could about the industry. Started traveling on my free time to learn about meet up with different groups, started joining meetups on real estate investing, and eventually started immersing myself in a culture, started learning about the people that are really doing things versus the people that are just talking about it. And then I started learning how to analyze deals. And I think that was what really my desire was, to get in there and go find all the deals myself at first. And when I started meeting brokers and getting deal flow and putting them into, the underwriting templates and doing rent comps and CapEx budgets. And I did that for about 9 months, maybe a year and a half. In total, it was about 2.5 years before I ever got into my first deal. But and I talked to a bunch of very experienced people. I befriended a bunch of very experienced operators in the space and kept bringing deal after deal after deal until one of them finally said, "Hey, look, let's work on this together." And so that was went through a portfolio of 3-bedroom, 2-bath to my first multifamily was an 86 unit.
nice. And then what did that first partnership deal look like? So, because then that's someone you had met either in the market or at a conference.
Yeah. So I had at numerous conferences, and I had started helping out in any kind of way that I could figure out, and sort of building that trust along the way. And I didn't even negotiate, hey, sign this contract for a certain partnership percentage. I was more like, hey, I'd like to just tag along for a ride and learn how to play the game, right? And like how it really works. And like many things, it's like in engineering, when you actually get into it, things work a little differently than you learn in school. So
Yeah, for sure.
it wasn't until the end of the second deal where we had actually formalized, here's a partnership percentage. And, and then by the time we were on the third deal, it was on rails. And, it was a really good fit. And I think that's really the best way to partner is just to get in there and see who's, what we like to call adding value, right? And not spend all your time negotiating who's going to get what percentage, but let's get a deal done. And then let's on the other side of it, see if we want to keep working together and who the real players are.
Yeah, it's interesting you say that and that you were willing to do that, because I think that's very unique, because most people wouldn't do that. They wouldn't say, okay, I'll potentially, I mean, you could have gotten screwed over on that first deal. And what's interesting is I have the same mindset as what you're talking about, where if I was going to get screwed over, I'd want to know on the first deal, not on like the 20th. Like if we really need to have every little thing in the contract from the first minute we work together, like that's probably not a great partnership anyways. So, what were you thinking at that point? Like what was going through your head? Like why would you not need to have everything signed and figured out ahead of time?
Well, I've been a bit of a handshake, first who, then what kind of guy. And to your point, once you sign on a contract in these deals, you're married. You're married, 3, 5, 7 years, for better or for worse. And that's why I talk a lot about investors being passive, because as a limited partner, you're shielded from legal and financial risk beyond your initial investment. And oftentimes we can get that back through a refinance. But as a general partner in a securities offering, you have unlimited liability, right? You are personally liable. And that's one of the few industries where that's the case. So it's not all daisies and dandelions being a sponsor and operator like Drew and I in these deals. And so for me, we were moving so quickly, and I was so excited to just be in the game and to learn. And I was spending all my time figuring out what other jobs and tasks I could pick up along the way and learn. And I was learning so much so quick from some really awesome guys that I was just more interested in playing, right, than I was, saying, oh, stop, work with me, the new guy, on a contract and
Right.
sign on it. But we got there and we had a handshake on the general idea on what it was going to be, and that was good enough for me.
Yeah, no, that's great. And that's a great way to go through life, where, on one hand, you already had, money from your prior real estate investing and your tech career. So it's nice to take a somewhat of a gamble like that. And then if, see if it pays off, versus maybe that would have never gotten going if you would have said, I need to have all these things figured out ahead of time. They might have been like, we already got the deal, we got to focus on getting this thing done, not some new contract we have to all figure out and deal with. So I just want to highlight that, because credit to you for doing that, because there's been times in my life that have been similar where people are surprised I did something like that. But at this point, I was like, all I had to lose was time, or I'm also investing in the deal, but that, like, I own that part. So I'm just really speculating my time. And, if, I think I'll work with these people long term. So I wasn't really worried like that. So interesting. Yeah. So then, speaking of passive investors, I mean, what have you learned between, let's say, at that point where you've kind of got into your bigger, we'll call it your first larger deal, to today? I mean, why is passive investing so great?
Well, I've covered it a little bit. I think being able to take advantages over the real asset advantages, meaning that you're getting inflation hedged returns where our rents grow with inflation. It's hard to find something like that, right? And housing, food, and energy, or housing and energy specifically, tend to be very indexed with inflation, especially income generating real estate. And I have an article on Forbes about that. It's, Patrick Grimes' Inflation Forbes, if you're interested, kind of outlines how that's the case. But if, as a passive investor, you can take advantage of that, and you can have your retirement maybe win with inflation in that. in that case, but without having to sign on a loan, right? Because you don't have to if you're a passive investor, without having to risk, somebody tripping and falling at the property and coming and suing you personally, right? So just like you would if you had your own rental. And those are big deals because it turns out I know that there's frivolous lawsuits from people getting sued, but it was signing on the loan, which took me down in 2009 and 10, right? And as a limited partner, passive investor, they can't come after your assets. You're not cross collateralized. If you invest in a syndication, that's in an LLC, and the sponsors, the operators, are signing on the loans themselves. And if somebody trips and falls, you're insulated. And what that means is, and if you own them in like a Nevada, Wyoming, or Delaware LLC, for example, like I do, a holding company, it means that each of these investments, you're protected from them. On the other hand, if you own it in a Wyoming LLC, they're protected from you because if you get sued for accidentally knocking in somebody if you're driving down the freeway and hit a motorcycle or something and you get sued, then they can't take those assets if they're in one of those asset protected entities. But that's not the case if you're a sponsor. It's harder to do that. And they're not only are you protected from them and they're protected from you, but all of your individual investments are protected from each other. And that's that cross collateralization. And as a passive investor, you can invest not just trying to be active nearby where you're at or spreading yourself really thin all over the country, but you can invest with people that have decades of experience and a track record in all of the growth markets where it's landlord friendly and tax advantage, and you can build a diversified portfolio. And that's what we're working on with our investors. Also, like today's the day when you can go find really incredible deals. I mean, we just found we just stood up 4 deals where we were able to acquire them with the ability to get our capital back in less than a couple of years. In fact, 6 months to a year. And now we're rolling it up into a recessionary acquisition fund where acquisition 5 and 6 are going to be within this fund, where our investors have said, look, I'm going to take advantage of, right now there's a reset going on in real estate. So that means there's opportunity. Well, how do you get a hold of that opportunity? As a passive investor, you'll never know where to find it. You won't have the resources, the knowledge, or the network to do that. We're analyzing 1,000 properties. We're coming up 200 viable leads a month, and we're acquiring 1 or 2 of them. You wouldn't be able to do that. And so by investing into a group like that does have an acquisition engine, just the engine itself costs about $200,000 a year, just for the resources and the licensing and the people that just analyze and look for the properties. That's pretty sophisticated stuff. You can't access that kind of deal finding resources as if you were out trying to go do it yourself. And you don't have the relationships with the brokers.
Yeah, I was thinking that's even the biggest piece is, or even if you somehow did have the relationships, they're not, it's unlikely, whatever deal you're looking at, they're going to be vouching for you as a buyer. If you're a brand new investor, and it's hard to get the deals under contract. It's hard to hear about them. Because like 80% of the stuff we've bought has been like off market in some capacity, usually through a broker, but it's been not widely marketed, to that point. So, to get the same deal flow as like me or Patrick, like would be pretty tough. And then you're, you're doing all the work then too, as well. So, which to me is even the biggest point, almost the liability. That's a good point. Plus on top of what you said, the property has insurance and a general liability policy that can, step in on a lot of that slip and fall kind of stuff, but there's like a limit to what those pay. And then if it were exceeding that, that's going to like the decision makers first, and it's the sponsorship team, not the passive investors. So it makes a lot of sense. To me, the being able to diversify the workload piece is like important, because I think a lot of the folks that you have invest in your deals are already busy with their lives already, not looking for like a second job. So cool. Well, so then how are you guys how are you guys finding deals today, and what do those look like?
Well, all of the recent deals have been off market, as you suggested. So either broker relationships or in this acquisition engine that we have is actually direct to owner. So we're working to go the first four have just been direct to owner, and we're looking at those kind of mid-sized deals that where they're a little less sophisticated, they're struggling. The latest one, we just had a guy who inherited a property who's a programmer in San Francisco, and he inherited a property from his father in the Midwest, and he just wants to exit. He doesn't know what to do with it. He has just been sitting on it, and we were able to uncover it, and we're going to acquire that, and we're going to get our capital back within 6 months to a year. It's incredible. And so that's just sifting through those, finding those opportunities.
Yeah, no, I hear that. What's the deal size on something like that?
Well, we're going to start the fund. So far, they've been anywhere from like 1 million to 7 million. We're going to start the fund in that same range. Not that we haven't found the bigger deals. We found like 29 million deal, where we could literally get our capital back in 6 months to a year. But we're launching the fund with one $1.7 million deal and one $4 million deal, which is acquisition 5 and 6. And then the intention being with those, once we're buying it all in cash, because it's a little bit like whack-a-mole. You find these deals, you got to swoop them up quickly, right? So we can pounce quickly. And then we're going to backfill with 50% leverage, very, very low leverage, so they cash flow. And all these cash flow, by the way, these are not non-cash, they're not distressed assets. They're just distressed operators or owners, right? And then we can reuse that capital for our next acquisition. And we're gonna have tranches of equity raises when we need them. But the idea is to be able to not take on lots of smaller assets, but to take on the right assets. We have an incredible deal that's $29 million. We're going to be able to take that on in about a year from now, because we're going to have equity freed up from trading forward of assets within the fund, and also from capital raises. So our goal is to systematically, as we build diversification, one property becomes 2, 2 to 4, 4 to 8, 8 to 16. And as the liquidity comes open, we can then begin to continue to gain diversified by also doing larger assets. And that's part of the key to the fund's success.
And then how's the money from, let's say, the deal returned within 6 to 12 months, or how you were saying that's a cash out refinance where you're going to increase the leverage from 50 to just a higher amount once you've increased the rents and everything?
Yeah, so a lot of it is just buying, getting the deal on the acquisition, and then it takes us, like to your point, where sometimes we're doing a lease up, very little value add, not a lot of value add, but it does take us about that 6 months to a year is what we're conservatively saying, for us to get us to the full realization of the property's value. We had properties that we acquired for less than $2 million, which we were immediately able to get a valuation for $7 million. So it's incredible, the ability for us to get deals. Like I said, some of these people have no idea what they're sitting on. They don't really care about it. It was kind of their father's that past project, and it's not pretty looking to them. It's not a core plus beautiful thing like what you buy, Drew. It's not something you want to bring home and introduce to mom. It's a solid asset that's just been neglected.
Yep.
And they don't realize.
Yeah, I know what you're saying. The all the deals that we did in Chicago for this would be like 2013 to 2018, like in that time period, is all similar profile where the buildings they were actually, I would still describe them as they were nice, but it was all this operational. An operational play. Like we could buy it. It's a new deal from a developer, but they rented it out way too cheaply. So then we go in, we raise the rents. A lot of times, basically, the only thing we did was repaint the common areas and units like a way better light gray color. That was the only construction we were doing at most of these deals. And for 13 in a row, with about an average year of ownership, we were able to refinance out all the equity for 13 in a row. using the Freddie Mac SBL program. So, and like the same thing you're talking about, where we made probably most of the money on the purchase, but then we did have to raise the rents across the board to what they should be. But we were buying it, right, based on those low rents. So yeah, that's a great strategy. And I mean, I would think in the next year or two, interest rates going to also come down, which will help in terms of those deals are just going to go up in value as rates fall, and it'd be easier to refinance out more money, or just refinance and pay less interest, however you want to work it within the fund. So yeah, that sounds like a nice strategy.
Yeah, I think the key is really for us in this fund, it's the short hold, right? That way you don't have to worry about interest rates going up or adjustments going down. If we're in and we're out, we're trading forward, and we're in and we're out, we're trading forward. We just focus on making the money going in, and not spending a year or 2 or 3 or more trying to get from like 85% of the value to 100% of the value, right? If we can do a quick lease up, or just do some minor changes, minor improvements, we'll do it. But if it takes longer than 6 months, we've already got our value, and we're just going to trade it forward to the next, and then get that next stair step up in the next. And I honestly am not a big fan of that value add play right now as much as I used to be, because those incremental changes right now, it's harder to get the labor force to do the renovations. And that's the only reason I'm bringing this up. And there's supply chain issues with trying to get all the stuff you need to do the value add. And it's hard to get people out. And in places like Texas and Atlanta, where we used to get people out in just a couple of weeks, now it's taking a few months. And so it's just delaying things, right? So I think the reason why I like the recessionary fund is we just focus purely on that buy play, right? And not worry about all the noise, right, of trying to maximize it. And then we just trade it forward within the fund and compound returns.
Yeah, that's interesting. And so a lot of the holds within the funds are actually, I was assuming you guys were going to buy, refinance, then hold it within the fund. A lot of this is going to be where you're just going to sell it.
We're going to trade it forward. Yeah. So we're going to pull as much capital, and then we're going to buy another property. And then as soon as we can trade forward, we're 1031 exchange within the fund to the next asset.
Then you're selling the first asset, let's say. So yeah, asset 1, refi, buy asset 2. Once you find asset 3, it's about time to be selling asset 1.
Yeah, 1031 exchange asset 1 to asset 3. So 1 property becomes 2, 2 to 4, 4 to 8.
Okay.
So
nice.
and then each of those is a buy, play, stair step. So we're not hoping that we know going in before our money goes hard, we're confident we get our capital out in 6 months to a year, right? So we know going in, we're buying it right. We don't have to hope and wish and pray that we can value play or gamble on lease ups or really anything else.
Yeah. And also one thing that's interesting that you touched on is the 1031 piece. Cause so I've done like probably a half dozen 1031s. They've been easy, I felt like, to execute because on those deals, I just had one investor. So we were all going the same direction. All my equity was from one guy, and our plan was buy one, or was to sell it and then just buy a bigger deal. Whereas on a lot of these syndications, it's like some people want to be out, some want to stay in. The timing's tough to do. But yeah, that sounds like a real benefit that I just realized of a fund, where at the end of the day, the fund is the property owner. You're an owner in the fund, and the fund's doing the 1031. Is that how that works, or really how do the 1031s with the fund work?
Yeah, similar to you. Well, so our last 1031 exchange was, we have 80 some investors, and we bought for $27 million in Jacksonville, Florida, and in less than a year we sold it for $37 million. And so it was a pretty solid win.
Yeah.
And we had identified another property in Texas, and we said, hey, anybody want a 1031 with us? Let us know. All of them but like 3 or 4 went with us. We paid them out before we closed, and then we 1031 exchanged everybody else. But yeah, there was some work because there's some communication and everything. But within the fund, you're exactly right. Within the operating agreement, the PPM of the fund, we state the intention. This is a growth. This is a yield play. It cash flows. The further it's going to start cash flowing, maybe we're projecting about 3% because we're buying income generating real estate. We're not buying distressed assets. But as we get more properties in the fund, it'll cash flow more. But the goal, as stated and disclosed in the beginning, is that the sponsorship team will not be distributing the capital from refinances, liquidity events, and sales to the investors until a 3-year hold period in which you can call your capital back if you would like at that 3-year point. At that 3-year point, you let us know in advance, and we will then time the sale of properties like we did before, and we'll buy you out as we trade forward, or we'll distribute your proceeds and exit you from the fund. If you want to continue to move forward within the fund, you can, which will mean that you're going to scale at even higher returns than you were in the past, because you went from essentially investing in maybe 1 or 2 assets with 2, we're starting the fund with 2, to now you're at 12, and then you're going to be in, 36 by the time you do the next 3-year tranche, right? So the value, the yield play, and the diversification and scale just really exponentially grows if you're willing to take a little lower cash flow position, which actually does compound over time too. A lower cash flow initially, but to really take advantage of the upside we're seeing in this downturn. And that's really where you want to be. The rest of your real estate portfolio is struggling right now. Well, are you exposed to the opportunities that will balance that out? And tell you what, when I lost everything in 2009 and 10, I wasn't. I lost everything. And so I was all in and headed down with it. And I think if everybody, you take a minute, take a step back, be like, well, what if the market does crash? Where am I investing to ride the upside of that? And it's in these opportunistic acquisitions. And it's not going to be a huge cash flow play. That's not the point. But it's going to be a really awesome and exciting yield play. And the further the market goes, the higher the fund's going to go up.
Yeah, that's interesting. And yeah, there's not a lot of cash flow in the market. So you might as well be thinking about appreciation, at this point. So, because if you're a cash flow investor, just solely for cash flow, you'd be better off. Today getting on the lender side. You could do pref equity or hard money first mortgages. And be 8% plus on those mortgages, or doing 12% pref. But you're not getting any upside from there. Like best case is you're just gonna get your interest and pay back. I like the strategy. I got this 1031 story I always tell. But it's a perfect example of what you're talking about, where 2009, we bought an office building. We put $900,000 down on it, $930,000 to be exact, bought it for 4.4, sold it for 5.5 a few years later, 1031 into a shopping center, did the same thing. So, we doubled our money on the first deal, then we doubled that. So now we've 4x'd our money. Then the next 2 deals we bought, it was 2 shopping centers total for $18 million. So to your point, people could see the same thing in the fund, where you went from having $4 million of real estate making you money to now, fast forward, whatever, that was probably like over an 8-year period for us, where we weren't flipping stuff as quick as you're talking about. And now we have $18 million of property making us money. And every year on those 2 deals, which we still own, the cash flow and the loan pay down is about $800,000 a year. So 800,000 divided by 930,000 in, that's like we're making like a 90% return per year on that money, not even including appreciation. So folks could see something similar if they let their money ride in these kind of funds, I'd imagine. Not where you're going to make 90% or something, but in a year, but where you're going to see your money compound like that if you keep it in. Otherwise, a lot of times they'll go into syndication or something, and then they invest it. They got that double on the office building, let's say. Then they're kind of done with it, or they say, all right, well, I'll look for the next syndication to put my money in, and then a year goes by, and that's, who knows how big the buying window is. It could only be 6 months or a year. This is a little different than the 2009-10 times, where you literally could not get a loan. And I remember the second deal I bought in 2009, we were worried Wells Fargo was going to go out of business, and they were one of the tenants in the shopping center. How crazy is that? Where we were, if you think about, I know a couple, some relatively large banks went under this year, but thinking Wells Fargo might go out. That was like a top 5 size bank at the time, I think. It was wild times. So, But yeah, no, that makes a lot of sense. And then for that fund, you guys are really just you're targeting multiple markets, multiple product types, really more just looking for like a deal, like a good acquisition, so to speak. It sounded like.
Yeah, we do. It is all about the acquisition, but we do have some markets where obviously we have much greater knowledge and network and connections, and they're not in New York and California, not where I live. And, they're in the right places, but it is a little bit of a broader net than just being in, the specific cities of Houston, Dallas, Austin, Atlanta, Jacksonville. We're a little bit broader in that sense because we really want to just chase the best deal. Again, we're not betting on the long-term growth of these markets and, sustained. And that's not the case. We're just holding them for 6 months to a year each. So it's more just get in and then get out.
And then the system to find the deals, that's what does that look like? Kind of you had said you built it and it cost a couple $100,000 a year to run. Why don't you walk us through what you're doing specifically with that?
Well, I probably won't go too much into detail, but I came from a systems engineering background. So, there's a bunch of people that help sift through a bunch of opportunities, and there's licensing. And I have a partner actually that I work with on that. So, but that's obviously part of the challenge in this business is building a good acquisition engine. And that's not something that, we're going to lay out there for everybody to try and go replicate right now, and we're launching a fund.
Got it. Okay, interesting. Yeah, because I think a lot of people, traditionally they've done that where they're cold calling people, just kind of almost at random, but you would need some way to kind of pinpoint hey, here's like a new owner or some sort of distress going on. So then, that's like a common starting point here for folks. And then it's interesting from there what they do, whether they're calling them or sending them letters or they have a call center team. It's interesting. People are very creative.
The secret sauce is in the specific software packages, which we have licenses that allow us to pinpoint exactly where to go.
Yeah, because otherwise, if you're just going to cold call like everybody, you need to be way more targeted than that, where you're not gonna get to the right properties. So,
but probably like you, I get a half dozen or a dozen cold calls a day, and I hate it. I'm not a cold call fan.
So you're being interrupted. It's tough. So, well, sounds good. Well, cool, Patrick. Yeah, let's leave it there. I think so. Then how would, so people want to get in touch with you? They want to, maybe I mentioned that email list, but what's the best way to get in touch with you?
Yeah. And I appreciate your patience with me. I'm super, super sick today. So a little bit slower. So if you watch this at 1.5 speed, I don't blame you. So Persistence, Pivots, and Game Changers is a book I wrote. I did a chapter in this. It was an Amazon #1 bestseller. I'd be happy to send your audience a signed hard copy of this if they would like. You just need to go to investonmainstreet.com/book. That's the secret link. Investonmain and then street.com/book. And then make sure you put in a promo code so we know who you are.
Yeah, we'll set it up for promo code Drew. Let's do that. Easy to remember.
Can we make it a little bit longer so it's a little more specific?
Yeah. Let's make it. Let's go with Breneman Blueprint then. That'd be
Breneman Blueprint. Let's do that. Yeah. That'll be real specific. Yeah. All right. So I love it. Persistence, Pivots, and Game Changers, turning challenges into opportunities. Brian Tracy wrote the foreword, but the other guys I worked with is Phil Collins, lead guitarist of Def Leppard, some entrepreneurs, NBA players, coaches, a lot of really great stories in there. If you're interested in connecting, you can always just email me, patrick@investonmainstreet.com. If you go to our website, investonmain and then street.com, you can go to just click on set up a meeting, the /contact link. Be happy to talk with you, see what your goals are, get you pointed in the right direction. Where we've got some exciting things coming up, really trying to position ourselves to take advantage of this recession or these opportunities coming out of the interest rates and everything else. So I'm looking forward to talking to you.
Great. Well, yeah, sounds good. Yeah, thanks for being on, Patrick. A lot of great info. And I think, today is a great time to be I think launching a fund really, I mean, from the both sides actually, like it makes sense for sponsors where still feel like we've been a touch early on, like if the deals have been there, if they've been discounted enough. Sounds like you're seeing them. So times now, but it took a while, I'd imagine, to set this up. And then this was like perfect for, from like your standpoint in terms of getting it set up. And now it's ready to go for people who want to take advantage of this. So I think funds make a lot of sense today. So I like it. But cool. Let's leave it there. So thanks again. Appreciate it, Patrick.
Appreciate your time, Drew. Thank you.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Breneman Capital's website, breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.